Okay, welcome. We've got a fair bit to cover tonight. It's a very current topic. It's probably a topic that's always on people's minds, but given the amount of change in the last 2 years, it's probably an even more topical, topic, if that makes sense. So is now a good time to sell is what we're talking about. We've got a great panel lined up. We just move forward. So just to introduce our experts, we've got Roy Sanderson, who's an accountant and key advisor to the property industry for over 35 years, so plenty of experience there. We've got Peter Scolo, who's been a commercial property investor, again for 35 years. And we've got Eric Shears, who is a residential property landlord and investor across multiple states for over 20 years. So we've got plenty of experience to share with you. As for myself, I've, like most Australian landlords, have a single investment property, but it's not me that you'll be listening to tonight. It'll be the rest of the panelists. So we'll move on to the next slide. So just a little bit about the Australian Landlords Association. For those who aren't aware, there's over 2 million landlords in Australia. So hopefully, if you're one of those, you're not feeling alone. There's plenty of us out there. And if you only own one property, then you are with the majority. Most only own one property, and many start out as accidental landlords. So one of the unique things about Australia is the ratio of landlords to citizens. Australia has the highest rate of landlords to citizens in the world. Regarding the association itself, it is run by members for members. So if you are a landlord, you want to become a member, we welcome you. If you want to become more actively involved, we'd welcome that too. One of the main things we set about doing is providing advocacy on legislation. So there's a number of legislative changes flowing through the different states and nationally all the time. And sometimes we can be caught unawares, particularly if we've got a set and forget attitude to property investment. Many of you may not realise that if you are an interstate landlord, as in if you live interstate in a different state to your property and it's a residential property, then you're unable to take that through the local courts unless you're in South Australia and soon to be Victoria. So that's one bit of the legislation we're actually providing some advocacy on. We also provide services and benefits to members, and to find out more about those, we recommend that you take a look at our website, which is australianlandlords.com.au. One of the other things that we're proud of is that all of our members are required to abide by a code of conduct, which certainly puts to bed anything time that people say that landlords don't behave properly. We know that all of our members do because they abide by our code of conduct. Tonight, for this event, we have an event partner, so we really are very grateful for RJ Sanderson for their support. They are a trusted partner of the ALA, and we mean that very sincerely. We are quite selective in who we pick as partners. We want partners who are familiar with the challenges that many landlords have and are familiar with dealing with the typical landlord, which is your mum and dad investor with a single property. And RJ Sanderson are a rapidly growing organisation because of the fact that they do look after our people like our members very well. And also because not only do they have great customer service, but they've got this great expertise in property investment and self-managed super funds. And so, we're really pleased to have them. So most of the way through the introductions, we've got presentations from the panel and then questions from the audience. So if you've come along tonight because you want an answer to a particular question, then I really recommend that you put that question into the Q&A section to make sure it gets answered. We will be getting to those after our panellists have their say. Please get on with that. And also, just to set the scene for this, we're going to have some very candid opinions from our panellists, and that's the way we want it. And one of the reasons that they're able to do that is that it is opinion, not advice, that they're giving. And so just to let you know that do not take this as specific investment advice. Property is a very big commitment and a very serious investment, and you should seek your own advice to do with your personal circumstances and not rely on discussions like this. which is not to say that tonight's discussions are not going to be very useful, educational and entertaining. So with that, we'll move on to introducing our first panellist, which is Roy Sanderson. As I said, Roy's had over 35 years experience as an accountant and key advisor into the property industry. So there's a wealth of knowledge there, and we really look forward to hearing what Roy has to say. So over to you, Roy.
Thank you, Andrew, and welcome everybody to this wonderful Wednesday evening. I hope you're sitting back, chilling, maybe having a cup of tea or a beer or a wine and just relaxing, and hopefully we can give you some good information this evening. When I'm sitting down with a client, I will ask my client a number of questions, and I've listed down some of the reasons why a client might say, yes, I want to sell a property. It might be because of COVID, might be because they believe there's going to be a property crash. There's so much more legislation, so landlord responsibilities. There might be a belief that interest rates are going to increase and that is scaring them. They may have a better use of their money. Now, that might include other investments. It might be that the property you're in now is not a good property or isn't performing, and you think, sell it now and buy a better property. Maybe to improve your lifestyle or pay off non-deductible debt, like paying off the family home is what I call a champagne moment. So you may sell an investment because you're clearing other debt. And you might believe that prices are at a historical high, so therefore now is the time to get out. Now, of all those points there, some of those I would strongly disagree with. Yes, interest rates are going to increase. My opinion as an advisor is we're going to have inflation. We can all guess what inflation will do to property prices, especially residential, and we can guess what will happen to rent. And there is, economists are forecasting we're going to have wage growth as well. So that will help things. I don't believe there'll be a property crash. I don't think in the history of residential, we've not had a property crash. We've had a couple level outs, very minor corrections. Commercial's different, and we'll talk about that. So one of our panelists will talk about that a bit later. But they are all valid points that I try to extract from my clients' belief or mentality on where they're thinking. And if they are super stressed simply because they're worried about interest rates going up, or that they believe there's going to be a property crash, then sell the property if they're super stressed. But there's just as many reasons to say the answer is no, don't sell the property. We know how much property does increase over time, and shortly I'll show you a slide which will show some of those, and right at the end we'll have a further slide about Australian property prices. You look at the history of increases in the past and you would expect that it should continue. Interest rates are historically low, and we know they won't stay low forever, but that doesn't mean that you should sell a property, because as interest rates go up, I'm pretty certain that rents will go up because of inflation. And I've mentioned future wage growth. So these are reasons why you might say no to a property. And it costs so little to own a property, especially at the moment. And I'm referring more to residential. Interest rates are so low. Rents are quite competitive out in the suburbs. I think inner city apartments are certainly suffering because of COVID, because of lack of travellers and lack of people coming here as students. And capital growth over time. We all know that when you retire and you are getting a pension, your tax rate is lower. And if you hold a property until you're in your lowest income point, then your capital gains tax can be lower, so you pay less tax as well. So that really tries to summarize all the reasons why you might sell or the reasons why you may not sell. And I just want to show a slide now that actually is what's called the rule of 72. And if you look across the top line, and in your mind, what do you think property will go up over the next 10 years? Do you think it's 3%, or do you think it's 10%, or something in the middle? The rule of 72 is that if a property or any investment grows by 7.2% per year, then it will double in 10 years. Conversely, if a property or investment goes up by 10% per year, it should double in about 7.2%. Now, if you looked across the top line and you said, I reckon property is only going to go up 5%, well, that's lower than historical, but let's go with that. That's a $500,000 property that in 10 years is worth 314,000. So you have actually saved in capital growth being capital savings, $314,000, $31,000 a year that you probably couldn't save based on your wage or your income. That's one of the reasons holding property for the long term is a big benefit to clients, because it creates wealth over time. I think that sums it up, Andrew.
Well, thanks, Roy. And I get the impression from that, although you haven't actually given us a conclusion about whether we should sell or not, or is now a good time to sell. Are you going to give us a yes or no answer on that at this point?
Not at this point. What I'd like to do is listen to Peter and Eric and see what they've got to say. And right at the end, I'll give you a definitive answer on whether I would fall on the yes or the no side of the equation. How's that?
That sounds fair enough. Sounds fair enough. Well, we'll move over to Peter now. So as I mentioned in the intros, Peter has over 35 years as a commercial property investor. He's actually also got some residential property, but the majority of it's in commercial. And so we're going to hear a little bit about Peter's background over that 35 years and where he's got to. And hopefully we might even get a definitive answer from Peter as to whether or not now is a good time to sell. So over to you, Peter, and look forward to hearing what you have to say.
Thank you, Andrew, and welcome everyone on this sunny, for a change, Wednesday night. Before I start, I sort of just want to quickly define commercial property and what it is. Essentially, it's a building that houses businesses, your typical retail shops, commercial workshops, storage, etc., etc. And they also include pubs and accommodation. But I've put those definitions as because that's mainly what's in my portfolio, those sort of businesses. My investment journey. I'd just like to qualify myself, if you like. Started in 1986. We started with my business partner, my wife. That's 35 years of investing. We've purchased a number of commercial properties, a number of residential properties. And yes, we went through the 17 and 20% interest rates. For those of you that are a lot younger, you probably don't know what I'm talking about. But at one stage, we were paying 17 to 20% interest rates. Yes, we went through 3 slight downturns in that time. I have a degree in ag science, in economics, and I joined the economics department with the ANZ back in 1984 for 5 years. And I tell you, that was great training ground for reading the economy, or try to read the economy, and understanding how business works. Now, that out of the way, before we go through the decision-making process on whether it's a good time to sell, I'd like to hone in on 3 areas that I think are fairly important in terms of trying to pick the trends, which will then help us make a decision. Now, they are the yields, quality of tenants, and the type of commercial usage. I think they're very important. So let's start with yields. Now, basically, what I've noticed the last couple of years is lower yields the yields are getting lower. Now, that generally reflects the price of the property value has gone up considerable in relation to the rental return. Now, I am talking about A-grade properties. I know that sometimes lower yields can relate to trying to get a tenant in a commercial property that's not on the highway or is, B grade. But generally, if the property is of A grade quality, the last couple of years, yields have lowered. Now, for example, a shop in the CBD, most of those yields are 1.5 to 2.5, whereas say a shop in the rural areas, in the shopping strips in sort of country Victoria, they're about 4 to 5.5. So that's the difference. The point I just want to make with yields is, as property yields have decreased for essential service type business during COVID, and that is the chemist, the warehouse, logistics, liquor stores, supermarkets. They have actually, yields have decreased for those because they are sought after, because basically they can pay the rent. Now, the second one is the quality of the tenants. Again, we've noticed over the last couple of years, essential services were in high demand for investors, obviously because they can continue paying rent. On the flip side, discretionary spending type businesses were low for investors. And I mean the jewellery shops, the cafes, the apparel type businesses. They were heavily impacted by COVID. And so a lot of concessions had to be given. The return on your investment was in some case nil. And so they really were not in flavour. So the point I'm trying to say here is businesses that were in properties and operating during COVID are worth more post-COVID than businesses that closed during the lockdown. Now, thirdly, the type of commercial usage. Now, the demand for industrial type buildings like businesses, plumbers, building supplies, mechanical workshops, they were in the industrial sense, they were in demand. And also logistics because of the e-commerce growth. Now, these prices, the prices for logistics and warehousing is gone in double digits. They were in high demand, particularly the more high-tech and bigger operations. Conversely, we've seen office space lower demand, but I still feel that was only in the CBD. Mainly because obviously people working from home, but I think people just didn't want to get on public transport and because of the scare of COVID. I don't feel the office space in suburbs had suffered as much. Now, the retail sector, that is depending on which areas you are, it's sort of touch and go. I still believe that there are certain retailers out there or shoppers that still like the touchy-feely bricks and mortar presence, and they would like to go and spend their money. But there's also a certain section of the population that still enjoys online shopping. But the point I just want to make here that is that non-essential services, the apparels and jewellery of this world, their commercial usage, unfortunately, it was just a retail shop. They couldn't change. Whereas commercial property, I'd seen a lot of places that were originally started off their life as gymnasiums, but ended up being closed, and then they opened up again as either warehousing or mechanical workshops or plumbers, depot, etc. So that's why it's important to look at the commercial usage of your commercial property. Okay, so they're the three that I think I consider important to understand. The review process, if you like. Yield, quality of tenant and commercial usage of each property. If you had to give them a score, if you scored somewhere between 7 out of 10 for each of those little areas, in your 70% range, your overall portfolio mix, in your portfolio, if you've got essential type businesses in your property or non-essential business in your properties, the mix is very important. Now, finally, the personal considerations, the time and effort required. Now, I tend to like to invest a set and forget type philosophy where I enjoy the long leases, where I can get multinationals or a franchise group to rent your building, and an icing on the case is if they're essential services as well. Cash flow and interest rate coverages. Well, if you notice, I talked about yield. In the rural area, your yields are pretty high, a lot higher than in your CBDs. So if you're starting off, cash flow is going to be beneficial in a rural investment as opposed to a city investment, and the higher yields will help cover your costs of principal and interest. And of course, alternative use of your money. Some people love the superannuation space. They like the share market, or in fact pay down debt, whether it's your home loan or your debt just in general. So my decision at the end of all this, I won't be selling. The investment properties that I've got have got businesses that were essential services. I don't think I planned it that way. It just seemed to have happened that way. And what I mean by that are tyre outlets, motorbike shops, professional services, conveyances, accountants. They seem to have managed the storm that is COVID. So I'll be holding, not selling. As I said before, the quality of my tenants were COVID immune. So that helped me get through it. Yields did decrease, which tells me that the value of my properties were increasing, which is the direction I like to see them going. And the businesses were not affected by the online shopping, of course, or a shift in the workforce to remote working. So they were not affected. So I'm sort of steadily sailing quite nicely. However, I would consider selling if there was the opportunity to trade from a property that had, say, that had closed during COVID. For instance, I do have a training. Well, I conduct karate sort of in karate lessons in this particular commercial property. I would trade that in for a property that was an essential service, such as chemists or liquor, etc. However, post-COVID prices to do that, I would have to pay a premium because most investors would be looking for the same thing, and that is surety, that they're not going to be locked down. So you will be paying a premium. And of course, when you consider selling, you know, the agent fees, the marketing campaigns, the capital gains implications, and the stamp duties when you buy again, these are all questions that really need to be answered by professionals, and that is accountants and solicitors. And, you know, if you get a good team around you, it helps with the process. Andrew, that's about it. Thank you.
Thanks, Peter. Fairly comprehensive. So I'm sure for all those that have got a commercial property, you've given them a lot to think about as to whether or not now's a good time to sell. And probably from what you're saying, it will depend very much on what they own and where. Now, we'll continue on with our panel, but just before we talk to, or we have Eric tell us about what's going on, I will remind everybody that this is intended to be an interactive session. So even though you can't talk as an attendee, we are very, very much looking forward to hearing your questions. So please, as they come up, don't hesitate to put them in the Q&A section, and we will get to them after we've heard from Eric. So we'll just jump across to Eric. So as I said earlier, over 20 years of residential experience, including in multiple states, and look forward to hearing from Eric, because I'm sure quite a few of the people who are online are actually have a residential property and are wondering what's the right thing to do with it. So just good to hear what your thoughts on that, Eric.
Thanks, Andrew. Good evening, everybody. Well, for me, it is never just the question, should I sell? I'm always focusing on the bigger, more complete picture, and that should I sell, buy, or hold? I approach this by beginning with reviewing my investment strategy. I'm looking for the modifications that need to occur to meet my investment goals in light of the current and forecasted markets and events. Investment goals are very personal, and the investment strategy to achieve those goals is equally very personal. That's why it's really important to engage the services of good professionals in order to derive the best advice that relates to your personal circumstances in order to achieve your personal goals. Having said that, my investment strategy is a function of my appetite to risk, my investment horizon, my knowledge and understanding of the various asset classes and markets, my available time, level of interest to manage, and so on. I'll let you in on a couple of little secrets. In the last 20 plus years, I've purchased 10 properties and sold only one. That might give you a few clues to my investment mindset. But today, when I take into account of all considerations for all of my properties, which Andrew said is spread across different states, I find myself not selling, but buying. So when it comes to my property portfolio, matters that I review and consider in no particular order are as follows: access to funding, my ability to leverage and borrow funds, the cost of those borrowed funds, the interest rates, anticipated changes to those interest rates, and inflation, etc. And most importantly, my personal cash flow. Can I fulfill my financial obligations and maintain my standard of living? Especially if there was to be an increase in interest rates. I like sleeping at night, so that's a fairly important one for me. Moving on, there are various taxation considerations that need to be taken into account. Capital gains, tax, land tax, personal tax, all very complicated and constantly shifting and drifting with changes. I always consult with a qualified professional to ensure that I'm accurately informed. Great accountants are definitely worth their weight in gold. Then it's to a more focused consideration of each property. Looking at the demand and supply of similar rental properties in the same area. Are there any new property developments that could create an impact? Rent expectations. Typically it's up, down, or the same. Usually you can get great advice from property managers or just talking to agents in the area. Known upcoming expenses to the property. They could be of a capital or maintenance nature. If you're aware of those, they might be large, possibly, and might guide you in a particular direction. And then, of course, there's the property valuations, current and forecasted. The forecasted growth, Roy touched on that a little earlier. Always very important because your ability to borrow funding is a function typically of your cash flow and your property valuation. Moving on, in the past year, we've seen changes in legislations in several states. Changes in Victoria commenced from the 1st of March or in March this year. And the first of Queensland changes commenced in October with more changes to come and dates to be set. But it is highly likely in this landscape that change will come from time to time in each state as the pendulum of tenant-landlord responsibilities moves backwards and forwards. And as such, it's going to be more important than ever to keep abreast of these responsibilities. Then other considerations, such as economic development considerations. I have some experience in this space, so for me, I make inquiries to see what any of the three levels of government are proposing. Economic development is typical large sums of money invested in infrastructure, such as hospitals, expansions, roads, that kind of thing. Keeping abreast of these economic development initiatives can prove very beneficial. These are typical investments by the governments to promote economic activity, and most local governments have an economic development department, state and federal governments equally as well. Considerations to town plan amendments, changes in zoning. As the nature of our cities have changed, higher densities are being designated in areas that were not previously. And as a result, developers are looking to aggregate land holdings to develop land to its highest and greatest use. You really want to be on the right side of that equation if you're in a position where something like this is going to affect. That's something I watch closely with my portfolio with property that are in those positions. And there's other matters such as changes to personal circumstances, major insurance considerations. When I purchase a property, I seek the property to have the ability to have some unique appeal or access to amenities, or the ability for me to add value to it in some way. And whilst it might be unlikely for a property to lose an attribute of this nature, it's important for me that the property has that quality and the quality remains. And lastly, what are the investment alternatives to property at that time? Thank you. Back to you, Andrew.
Thank you, Eric. And look, I'm going to take the jump on those who have got questions from the audience. And again, I encourage you to get those in. We will be picking those out and asking them for you. But I've got a question that I've prepared earlier. And in fact, I've even slipped a graph in. So yeah, please submit them online. Here's my graph. Not that I created it. This comes from the Australian Bureau of Statistics. It's their established house index. So one of the nice things about the established house index is that it's measuring the same thing over a long period of time. So it's not, it's not distorted by the type of housing. It's not distorted by new housing versus old, etc. It's established housing over a period of time. And this is the 8 capital cities index. All starts out evenly at in March of 02. So we've got nearly 20 years worth. And what we can see in here is some ups and downs. And the big winner over that period of time is actually Hobart, which is the green one at the top there, if anyone's having trouble reading the fine print. Now, that's a long preamble for a question, which given that you've all kind of said that now's a good time to not sell, is now a good time to buy. So we might jump to you first, Peter. Is now a good time to buy?
Oh, I knew you'd ask me that. Okay. Look, personally, for myself, I'm holding for about 12 months. I just want to see where COVID will settle. That's the first thing. And what I mean by that is how it will affect business and interstate travel and international travel, backpackers, etc. I'm on the fence with interest rates. I have been watching the inflation rate in America, and usually when that inflation rate goes up, our cost of borrowing seem to go up. I'm waiting to see what the jobs market is going to do over the next 12 months and inflation here locally. So the Reserve Bank doesn't seem to, one minute it's saying that interest rates are going up, next minute it's not going to happen until 24. So for me,
it's a hold.
I'm going to hold. I'm not going to buy. I just think there's too many variables. I feel a little bit uncomfortable. Yeah, that's from my answer.
All right, Eric.
If we can go back to the graph, please. To me, that graph is, if you draw a line of best fit through that, it's moving in one direction over that period of time. And that, for me, I look at that and I see any point potentially along there, a good point to buy if, having my investment horizon being long-term. Short-term, there's a lot of noise in there. And for me, property is not a short-term investment strategy or approach. I'm definitely a long-term with my investment horizon. So I'm very comfortable buying at any point along that, knowing that that line is probably going to extend beyond it in the future. For me, that would be my view, and I would be comfortable buying and holding on during that time.
And so just before we jump across to Roy, I'm going to put it, given that you do invest interstate, Eric, if we look at the dark blue one, which is Darwin, and we go to 2014, so if I'd bought in Darwin in 2014, I'm underwater even still. So how brave are you on location? And the other one, just before we jump to that, is price rises and falls in Perth seem to follow the iron ore prices. So how much of that comes into your consideration in the long term?
Well, I don't follow iron ore closely. I see the point that you're making, though. On the buy side of the equation, there are a few extra considerations that I would throw in there, centered around what are the winners for that area, the state? What are the economic drivers? What's price history been like? Consistency is always good. Slow and steady. Location, location, location. I know these are typical cliches that are thrown around when we are talking about property, but they remain true. And it's important to do your homework. For me, buying in locations that don't have a lot of demand in all respects and sense of the word, I probably wouldn't consider it.
Okay, thank you. So, Roy, you've been very patient as I get the other two to ask, and I've also just remembered that you did set us up some time ago to say you're going to give us a definitive yes or no on whether or not now is a good time to sell. So we might get the answer to that question first and then get the flip side of that, which is now a good time to buy.
Okay, well, firstly, if we go back to the graph, please, Kat, I'll comment on the graph. But to answer the question that I said I would answer, and that is, should we sell? I would argue that we should not sell unless, and I say with a big unless, you're paying off the family home, which has non-deductible debt, because once that debt's paid off, you can re-borrow to buy another asset and create deductible debt. Or you've got an investment that you think is a very bad investment and won't recover over time. And that might be because it's got capital problems, as in it's not in good condition or it's in a very bad location. But be careful about selling something that's in a bad location, because often they recover eventually. So I fall on the side that you should only sell if you have to, and you keep the property for the long term. It's not about when you get into the market, it's about how long you're in the market for. And that's what I would be pushing. Looking at this graph, interestingly, you picked out the worst two, which is Perth and Darwin. Both of those areas are related to mining or outside factors, which I think people knew before they started to slide in value that they were overpriced at the time, because there was like an artificial demand. Take out Hobart has been a standout, but if you look at the rest of the areas, most of the areas, when they have a reduction, and maybe if we just look at July 2018, we had a drop in most areas in July 2018, somewhere around there, and they started to drop. And by December 2020, all of those are pretty much back where they were. So it's not about when property prices drop, it's not like the stock market when they use the word collapse. I don't believe the property market collapses, especially residential, and this is housing, so it's residential. So it's a safer investment. I believe that you ride out any reduction, and if you're there for the long term, any time is the right time to buy property. That's my opinion.
Okay, thank you very much. We've actually got some questions from the floor that I'll read out. So I've got to put the glasses on momentarily. So we'll go to one from Jeffrey first, which is continuation of the current support packages re residential property will increase what has been termed intergenerational equity, i.e. your parents have a house, then you will, and if your parents are renting, you will. In the long run, this appears to be a risk. So do you, I guess, see that as a long-term risk to property ownership at the moment? Or how do you want me to read that again?
Yes, please.
Yeah.
Okay, so this is on the residential side. So continuation of the current support packages re residential property will increase what has been termed intergenerational equity, i.e. if your parents have a house, then you will, and if your parents are renting, you will. In the long run, this appears to be a risk. Do you agree that it's a risk in the long run?
I'm not sure where I see the risk, Jeff, who's asked the question. I believe that people who have parents who have bought a property somehow educate or give the belief to their children that it's better to buy a property. But in the same breath, I will say that where you've got parents who have rented all their lives, believe that it's a waste of money and there's too much risk in buying property, and often children do the same. So you tend to follow your parents. from what I've just seen from generation to generation with our clients.
Okay. Eric, Peter, do you want to add to that, or are you happy to go with Roy's answer?
I'm happy with how Roy's answered it. Yeah.
Okay. We've got another one here from Mel, which is, if you were to buy a property today, where would it be? And
Mel,
I guess given that we're opening that up, we'll just ask, where will it be? And I'll add to that, would it be commercial or residential? So, Roy, you look keen, so we'll go to you first.
I was going to ask Mel whether she wanted the suburb, the street, and the street number and the house number. I'll tell you what, and I'll talk residential because I know it more. I would argue, and I'm going to talk Melbourne. I have some strong beliefs. I don't believe you should buy where you don't know. If somebody comes to me and says, I'm going to buy something in Perth, I don't know Perth or Queensland. So I'm not going to personally buy in those areas. I think you need to know the area you're buying in. So if I'm based in Melbourne, I love anything on the Mornington Peninsula. Up until very, very recently, I've been saying stay away from the city. But right now, apartments in the city are so well priced, you can pick up something for $220,000 to $300,000, a 1 or 2 bedroom apartment that you need to check out whether it's got any cladding issues. But there is some very cheap property in the city at the moment. And for the last 8 years, I've probably said stay away from the city, but that's opening up again. Mum and dad investment area is what I call modern everyday suburbia, 550,000 to 900,000. I'm not talking about an investment unless you've got high income and good income. I wouldn't be looking at, Toorak or Camberwell. But if I had lots of income, then if there are price corrections in the property market, generally Camberwell, Toorak, and the very high priced areas do drop. So if I had to put my hat on something, sorry for a long-winded answer, Mornington Peninsula, I think you can't go wrong.
All right. We'll go interstate for the next answer. So, Eric, where would you be going? And you could come all the way back to Melbourne, but
I could.
From afar, where would you be?
Well, great question, Mel. Currently, personally, I'm considering commercial property. I haven't set on an area, but as Roy said, I'm beginning my due diligence process and focusing on the areas that I know.
Okay.
Yeah.
Thank you. And Peter?
Look, I'll just go by my experience, and I've had success in being at the fringes of Melbourne and then just watching Melbourne expand. And I've applied that strategy quite a number of times, and I generally follow major arterial roads. So if it's down the south, I'm based in Melbourne. I'm talking, well, when we started buying in Cranbourne, which was then a country town and now it's a suburb, Pakenham, which was a country town, is now a suburb. If you go north of Craigieburn, I find that your entry level is not unachievable, but if you just sit tight and wait for the growth of the construction of houses to just keep going, there's only but a positive side, because more population comes in, your commercial property, or in fact your residential property, just increases in value. So my advice is the city fringes. Okay,
thank you. Some great advice there. We've got a few questions coming through, and we've got to thank you from Mel for that. So got another one for you, which is how often would you recommend getting your property valued, and how often would you recommend refinancing? And so I think we might throw that one to you, Roy.
Yeah, you should be looking at your financing often. Don't just take it for granted. At least every 12 months. If you're going to fix it, then you fix it for a period of time. interest rates were very cheap for a while. I know in our newsletter, we were constantly saying, look at fixed rates if you want to hold your property because they're historically unbelievably low. As far as valuations, we know that if it's owned in a self-managed super fund, it's got to be every 2 years. And I would think that get a valuation when you are thinking about a further investment because you're building up a property portfolio and you want the valuation to see what you might be able to borrow because you want to work out how much equity you got. So I would go every couple of years.
Okay. Eric, Peter, any difference to that, or are you happy to roll with that? We've got a couple of other questions on the.
Just briefly, look, I've read a lot of literature about people buying 2, 3, 4 properties within 4 years, and they get their properties revalued, and then they get enough money to put a deposit on the next one. But I find that when you really look into it, their gearing ratios could be as high as 80% or 70%. Throughout my investment career, I've never geared any more than about 25%. So I'm very conservative on gearing, just in case, because I've gone through those 17 and 20% interest rates. I've gone through those. So I'm very conservative. And so I generally don't get my properties valued because I generally have enough equity to get a deposit without sort of doing, I'm not in a hurry to buy 5 properties in 5 years. So the premise of the question, that's where I'm not answering the question, but just the premise of why people do it, I question, that's all.
Yeah, sure. Just we've got a quick follow-up question on that one, Peter, which is, can you explain gearing ratio?
Oh, sorry. It's quite simple. If your house is worth $1 million and you're in debt at 500,000, help me, Roy. What's the gearing ratio there?
Yeah, 50%.
50%.
Yep. LVR.
Basically, your debt to what you own. So if you've got 3 or 4 properties, they're all, and they're $2 million or whatever, and you owe 200,000 on that. Do the calculations there, Roy. What is it?
How much was it? 2 million in property?
Yep, and you owe 200,000. Your gearing ratio is about 10%.
10%.
10%. Yeah, that sort of thing. That's how you work out your gearing ratio. And I find that a lot of people are gearing very highly, and I get a bit nervous. And that's just me. I'm probably conservative.
No, that's okay. We'll move on to the next one.
I might add to that though, Andrew.
Yep.
25%. It depends on where you are in your life cycle, because 25% is very, very low. You'd love to be there when you get close to retirement, but if you want to gearing up for property, we know that income protection kicks in when you borrow 80% of the purchase price. So preference is not to go over 80%, but you want to get into the property market. And if you have to go to 85%, then do so, because as long as on the premise that property goes up, your equity increases. So that rate comes down over time. Sorry, I just need to add that in.
You're right.
No, that's okay, Roy. Thank you for adding that. We've got another one, which is probably puts you outside the landlord category, but is thoughts regarding investing in residential land as opposed to debt. So do we have thoughts on that? Let's start off by, have any of you done it?
It doesn't fit my investment profile.
Roy?
Peter first.
Oh, I think it's a good idea. Particularly, I think my children, for instance, they don't have enough for a house, so they'll go and buy a residential block. You can pick up a block on the outer suburbs, say a couple of $100,000, and do absolutely nothing to it, and just pay the loan off it. And then within 2 to 3 years, when they find a partner and they want to settle down, they can sell that residential block, and the capital, or the appreciation, they'll have enough to put towards a home. So it is a way of, I've never liked money in the bank, of course, but it is the way to sort of get ahead a little bit, if that makes sense.
Okay, so one for, one against, and the balance of it, Roy?
There's no rent coming in. So if you've borrowed money, you're paying the interest, and there's no rent coming in. There's no tax benefit. I'm against it unless it is for the purpose of buying a family home, as in you're going to build on it, and that's the reason you've purchased it. But otherwise, we want rent to come in to pay the loan. That's the whole reason the whole property thing works. Otherwise, you're out of pocket for the interest. It's reducing your borrowing capacity over time. It's reducing your savings capacity, and you've got to hope that land goes up in value. So that's my thoughts. Okay,
great. Thank you, Roy. We've got another question here, and it's an interesting one. I'll put another sort of statement on the end of this one, but I'll ask the question as it is, which is rental yields for residential properties are now very low after all the costs are taken into account. This means that the expectation is for continuing capital gain to provide the overall return. If interest rates rise in the coming years, then the expected capital gains are unlikely to eventuate, hence the yield will not meet expectations. So he's asking for comment on that. So my first comment on that is that we know statistically that over half of Australia's 2 million landlords actually make a loss on their property, which is a very similar thing to what Jeff's just said there, which is that the underlying assumption on that is that because they do negative gearing, so the underlying assumption on making money out of property investment in that way is that the capital gain will go up. So I guess more broadly, he's put one reason why that may not eventuate, which is interest rate rises. So more broadly to the three of you, and I think we'll get to you last on this one, Roy, so we'll go to Eric first. Do you think that capital gains in the residential space are likely to continue? Or do you think they're going to slow as interest rates and other factors come up, to lack of migration, those sort of things?
For me, there's a little bit more information needed, because I don't think you can throw a blanket over all property in Australia. It's going to depend on where we're talking about specifically. And if we're talking about interest rates moving up, then the thought that I might be asking myself, well, why is that happening? Is it triggered by inflation? If inflation's going up, then what impact's that having on prices? And typically that might see valuations move up with it. But once again, it comes back to what property are we talking about? Yeah, so a little bit more specific information sort of needed there.
Peter, it is a residential question, but I know you've got some residential experience. You're happy to?
Yes, look, I did this last week. My mum is in a position now to buy a unit. She's got a number of residential properties, but we did this last week. A country town. Well, I don't mind. It's Wonthaggi. You can buy a unit there at the moment for around 400,000. The rental was about $320 per week. Now, help me, Roy, if you've got a calculator, but I think that came to a return of about 5%, just off the cuff.
What was the purchase price? Sorry,
400,000, and they were getting $320 a week.
Yeah, about 4%. 4%.
So, the first thing I'd like to say, I do agree with the questionnaire that if you buy a property in maybe suburban Melbourne, your rate of return or your yield might be less than 2% or 1%. But there are some yields out there in rural Victoria where you can get a better yield. Sorry, what was the last part of the question? The capital gains. Look, you won't. I don't suspect that the growth in the rural town would increase. So you've got to sacrifice something. You can benefit from yield, but not benefit as much as capital gains, or you can do the opposite. So what I'm saying is, if you're getting 5% capital gains, you probably won't expect much capital gains. You'll expect a little bit, but not as much as if you were investing in the city. or in the suburbs.
Now, just a little bit conscious of time, Roy. Can you keep your answer to this one fairly short? Then we've got one more question, and I think we'll bring it to a close.
Okay, excellent, Jeff. Great question. My opinion is this: we're going to have inflation, and we're going to have wage growth. That's my opinion on what I see. If we have inflation and wage growth, we'll have rent increases, and yes, we'll have interest increases. We will continue to have capital growth, but I don't think it'll be at the same level. I think it'll even out a little bit. That's my short answer.
Great, and a great short answer. And I think the next one's a little bit related to what Peter was saying, which is, and this is our last question. So, and it's, as you said, it could be an either or one, Peter, but when assessing a potential investment, do you prefer an investment with high rental yield or a higher capital growth potential? When weighing up that, which is your preference? So we might start with you, Peter, because you were talking about it.
Yeah, I think Roy hit the nail on the head in saying that depends where you are on the investment cycle. I'm towards the end of it, so I've got a bit of equity behind me, so I tend to go for more capital growth. Whereas if you're at the start of the cycle, where you want to service your debt, you really have to sort of look at your yield. It becomes more important. And so if you're starting out, yield is important, so you can service your loan. So
great.
That's my question.
All right, Eric?
Look, for me, in my portfolio of residential property, I hold a mix of high capital growth, low yield, and the reverse. So high yield and not that fantastic capital growth. So I guess it will depend upon what I'm actually trying to achieve and looking for. I'm happy with either. It just depends on what my next move might be after that purchase and setting myself up for that.
Thank you. Roy?
It depends on you as the individual. Do you need the income? And if not, then go with the capital growth. The ideal situation, you have a mix of both. You certainly want the income to cover your costs if possible, but it depends on where you are in your life cycle and what your circumstances are.
Great. Now, a really good session, everyone. Now, just as we get to the thank you and wrap it up, one of the things I would like to point out is that this is the first, well, not the first, but this is the next one we've got. So rather than saying that is, we're going to be looking next month at what is coming up in 2022. So what to expect in 2022 is our next topic. We'll have a different panel, but no doubt, given their performance tonight, we'll have this panel back again. And also, I would encourage everyone listening to jump onto the Landlords Association. At the very least, subscribe to the newsletter. Ideally, jump on, become a member. The more members we have, the stronger position we have when doing advocacy on your behalf. So, getting some laws changed throughout the country. As you may well know, there's some others who are doing a pretty good job of advocacy in the reverse direction. If you want to have the landlords have a strong voice, please jump on and become part of the Landlords Association. And with the newsletter, you'll find out when next month's event's on, but I can tell you what the topic is, and that is what to expect in 2022. So thank you, first of all, to all of our panel members. It was very educational. We've managed to hold the audience the full time, even though we ran 15 minutes over. So I think that says a lot for the quality of your answers. And thank you too to everyone who tuned in and for those who provided questions. And we look forward to doing it all again soon. So, and let's not forget, thank you very much to Kat for running such a professional show. So thank you, Kat. Much appreciated. Thank you all.
Thanks, everybody. Have a great evening.
Good night, everybody.
Good night.
All right.